Welcome back to the Steadyhand YouTube channel. I've been getting a lot of questions about bonds recently. Probably because bonds are off to the worst start of the year since, well, ever. In the first half of 2022, Canadian bonds are down more than 12%. And that's come at the same time that stocks are also down double digits. So understandably, people are asking, should I even be owning bonds anymore? Well, the answer is yes. And in this video, I'm going to share the 3 reasons bonds still deserve a place in portfolios. Before I get going though, I should mention that my comments are going to be general. Your situation is unique to you. So get in touch with us for thoughts about your portfolio. And that's regardless of whether you're a Steadyhand client or not. We offer Canadians free portfolio reviews. You can also join us for our monthly Straight Talk with Steadyhand sessions. These are live sessions in which we offer our thoughts on recent market developments and give you the chance to ask any questions on your mind. We'll link it in the description. So reason number 1, why bonds still deserve a place in portfolios. Diversification. Probably guessed that. The main reason you hold bonds in your portfolio is not for returns, something we often forget, but for diversification. Bonds tend to zig when stocks zag because in general, bonds are safer than stocks. So when stocks fall, investors tend to flock to safer investments, like bonds. So even now, yes, Canadian bonds have fallen, but most stocks have fallen more. In the first half of 2022, global stocks are down more than 19%, about 19%. Canadian small caps were down 14%, emerging markets similar. Really, the only market that wasn't down as much as bonds was Canadian large cap companies, and that's mainly because of energy stocks, which did well because oil prices are high. Which means that overall portfolios with bonds have done their job. They've dampened the volatility for investors that can't bear the full extent of market declines. Now, it is true that bonds have not provided as much diversification, which takes me to reason number 2. The second reason you should own bonds is because the outlook for bonds is better today than it has been for a while. And that's both from a diversification and a return perspective. Bond prices rise as yields fall. And the problem we've had for a while is that there wasn't much room for bond yields to fall. They were already at record lows. To put some numbers on it, the yield on a 10-year Government of Canada bond was just 0.5% a year ago. And that approximates a rate investors were willing to lock in for 10 years. It's hard to get much lower than that. By contrast, today a similar bond yields about 2.8%, which means there's now room for these yields to fall if we have turbulent stock markets in the future. Current yields are also a good predictor of future long-term bond returns, meaning that investors are likely to get more out of their bond portfolios going forward now that yields are higher. Now, the third and final reason is that higher rates are already priced in. Investors are wondering about bonds because interest rates are expected to keep going up. And as we mentioned earlier, interest rates and bond prices move in opposite directions. Bond prices rise when interest rates and yields go down. And the opposite is also true. So if interest rates are going to go up from here, then bond prices might go down. At least that's what people are wondering. But, and this is very important, it's not about whether rates will rise or not. It's about whether rates will rise more than what people expect them to. Because investors' expectations about the future is already embedded into the prices today. In fact, we can even calculate some of that. At the start of 2022, we could calculate that investors in aggregate were expecting the Bank of Canada to raise interest rates by 1.25% in all of 2022. And as of the recording of this video, the Bank of Canada has already raised rates by 2.25%. So yes, prices have fallen, but not because rates have risen, but because rates have risen more than what people expected. And that would need to keep on happening. Rates would have to keep on rising by more than what people are expecting for prices to fall. And this point is relevant for any investment. Prices of stocks and bonds today already reflect investors' outlook for the future. Prices don't change just because something has happened. It's because whatever has happened has changed people's expectations for the future of that investment. So I hope you found that useful. And if you did, share it with someone else. It might help. And let me know in the comments section if something is still fuzzy. I'll do my best to explain it in a different way. And as always, like and subscribe. It really does keep me motivated to make more of these videos. Thank you. Take care.